The Federal Reserve has begun its two-day policy meeting, and a decision is expected on whether the central bank will raise interest rates from their historic lows. With unemployment at 5.1%, the job market is considered to have recovered. And while a hike in the benchmark rate has been highly anticipated, the big question is the timing.
The view now is that the Fed takes a pass at this meeting, and the thinking is that we will get an interest rate increase later this year.
Until recently, a September rate hike seemed to be a lock. But China's move to devalue its currency last month spooked investors and raised concerns about the stability of the world's second largest economy. Pinpointing how markets will respond to a rate hike is difficult, but economists say they expect the impact on consumers to be minimal and gradual.
You might see the stock market respond because low rates have enabled so many businesses out there to engage in share buybacks that bolstered their prices or refinance their debt to increase their profits. When rates rise, it squeezes those profits. So you might want to look for the impacts in your retirement account, your mortgage, and your car loans.
Investors are edgy as the Fed's decision nears. The Dow Jones Industrial Average remains down nearly 8% this year.
That the Fed takes a pause this time is understandable. The Fed wants to see a time when financial markets appear to be more settled. It would also like to see inflation rising at a higher rate. Whether that happens in the near term remains a big question.
When the Fed does move on rates, most analysts expect them to rise just 1/4 of a point at best. Luke Sheridan, The Associated Press.